So recall that on Thursday, for those of you who were here, we were talking about business fluctuations, how the economy fluctuates around its long-run growth trend, as the long-run growth trend being determined by the Solow model augmented for changes in total factor productivity. So we saw how a lot of variables actually move together, and some that don't move so much together. But what we need to start doing today and over the next several weeks is to develop a model that will help us actually explain those ups and downs of real GDP and the other basic macroeconomic variables. So that's where we're going to start. Our first step is something called the IS curve, which we will develop today. So the IS curve you can harken back if you want to think about I as investment and S as in saving. The IS curve is basically when investment equals saving. So we'll see how we think about that in a short-term context rather than the long-term context that we had developed earlier. Before we do that, however, I would like to talk about the results from exam number 1. Don't have to? Okay, so these are the results across all of the GSI sections. So one of the things that you can see as you look at this is that with the exception of Michael's discussions groups, the means and medians were very, very close to one another. So Michael's was a little bit of an outlier here. I've already talked to him about that, so no, not really. But now, a couple of things to keep in mind. Number one, I grade on a curve, okay? I grade on a curve. You've seen what the curve looks like. We talked about it on day 1. If you want to go back, look at the distribution of grades that's in the syllabus. It'll tell you what the grading curve looks like. Okay, number 2, again, you're only comparing your results against the students that your GSI has in their 2 discussion sections, except for Ite, who only has 1 discussion section, right? So it's only a comparison within GSIs, not across GSIs. So if you're in Kristen's discussion section and you happen to be looking at Michael's scores, don't panic. You're not going to be judged by Michael's scores. On the other hand, Michael's students aren't going to be judged by Kristen's scores. All the GSIs will have individual grading curves at the end of the semester. Okay? Third, this test was worth 20%. Not 80%, not 60%, not 40%, or 30%, or 25%, but 20%. Right? Even if we count both of your problem sets that you've turned in, 30%, maximum of 30% of your grade has now been earned, which means that 70% is still to be earned. Exam number 2 is worth 25%. Exam number 3 is worth 30%. We have 4 more problem sets, which could be worth up to a total of 20% of your grade. This means 2 things. If you didn't do as well as you had hoped, there's still time to recover. I have had students be 2 standard deviations below the median on exam number 1 and still earn an A- in the class. That does require that they do better than the medians on exam 2 and 3 in the problem sets. Keep in mind, exam number 3, you have all 3 hours. The exam is exactly the same size as exam number 1. Right? So time management should not be an issue. Right? So time management doesn't become an issue. So you have a great deal of control over your score on exam number 3. You've got up to 20 percentage points in your 4 problem sets, which you have at least a week to work on. So time management is not an issue on your problem sets. So you're already talking about half of your grade that can be earned where there shouldn't be any time management issues. Having taken exam number 1, you should have a much better idea of the time management challenges that you'll face on exam number 2. So being forewarned is being forearmed. Okay? Now, point number, whatever point I'm down to, 4, 5, 6, whatever. I intentionally give difficult exams. I intentionally give difficult exams because at the end of the semester, I don't want to have to tell some student that, oh, you were that close to getting the next highest letter grade. Right? When I look at all your weighted average scores, I want there to be some fairly chunky gaps between letter grades. It makes my job easier, and it means much less wailing than gnashing of teeth. If everything was really easy, then the scores would be very closely crunched, and somebody's not going to be a whole lot different than somebody else and get a lower letter grade. I don't like doing that. I'm sure you don't like receiving those kinds of grades. So again, keep in mind, the world's not over if you underperformed relative to your expectations. There's plenty of time to recover. However, if you did really well, you cannot rest on your laurels because there's still lots of opportunities where you could mess up, which I hope you won't do. Okay? So just to give you an idea here, the median for the entire 8 discussion sections was 66. Last semester, on the first exam, it was 67. 2 semesters ago, it was 68. I'm not talking about a trend here. I'm just talking about levels, right? So your performance is not unusual from what we've seen in the prior couple of years. So the distribution of grades, however, still look very, very similar to what is shown in the syllabus. Now, just to show you where you are year to date. So I've calculated weighted average scores for each of the GSI sections. And this gives 20% weight to the exam, 5% weight to problem set 1, and 5% weight to problem set 2, assuming that you're not going to drop either one of those. Therefore, the maximum point total you could have here would only be 30. So this isn't out of 100. You should look at this as being out of 30. So this is, again, gives you kind of a weighted average score. Now, if you're in Jeremy's section, you know that there were some issues with problem set number 2, which I did not adjust for in this calculation. So you can do that adjustment on your own if you want. Okay. Any questions about scores? Okay. Seeing no hands, hearing no questions, let's talk about the IS curve. Okay, so the IS curve. One of the things that we've talked about up to this point with our production function or the Solow model is we've talked about how much the economy could produce, right? How much we could produce. One easy way to think about that is the amount that we can produce, real GDP, has been a function of total factor productivity times some function of the capital stock and the labor supply. Right? Since this is how much we could produce, we'll see a little bit later, this is what we refer to as our aggregate supply. Now, we also need to think about aggregate demand. Right? As you learned in microeconomics, knowing supply without demand doesn't tell you very much. The same thing is true in the macro sense. So when we think about aggregate demand, we can think about expenditures. So here, when we had our national income identity, we saw that expenditures were consumption expenditures, investment, government purchases, and net exports. So we have a demand side and we have a supply side. We need to put those two together in order to talk about where economic output is and then what it is that causes economic output to change. So, as I mentioned, today what we're going to be looking at is the very first building block on the demand side, which is referred to as the IS curve. The IS curve is simply a relationship between economic output and the real interest rate. Now remember, we've already talked about the relationship between spending variables and real interest rates. You remember our saving and investment model had a desired investment function, which we saw investment was an inverse function of the real interest rate. So that, as a starting point, can motivate us towards expanding into more of a IS curve, an aggregate demand curve. We start here with the notion of planned expenditures. So this is what our IS curve is actually telling us. Not actual expenditures, but rather planned expenditures. So it's that inverse relationship. Wait, where we go? Planned expenditures. Here we go. So planned expenditures basically tell us how much spending we want to undertake, given all the other variables that we know about. Right? So we know how much income we have. We know how much taxes we have to pay. We know what the real interest rate is. All of those other things that influence our spending decisions. Given all of those things, how much expenditure do we want to make? We need to set that next to how many expenditures we actually make. Why is this not going forward? Right? How much expenditures do we actually make? Now remember, what we actually make is real GDP. You remember way back on day 2, one of the things we said, real economic output, real GDP, can be measured from a production side and also an expenditure side. So we're talking about how much expenditures are we actually making. Well, somebody's got to buy everything that's being produced. And this is where the difference between planned expenditures and actual expenditures comes about. Now, equilibrium will exist only when actual expenditures equal planned expenditures. We'll see in a minute that when that is true, there's no economic reason for anybody to change their spending or production behavior. We're producing exactly what consumers, businesses, government, and foreigners want to buy. Okay. Now, when we think about planned expenditures, we can come back to our 4 economic agents, consumers, businesses, government, foreigners, and think about how they spend their money. So we're going to make as a simplifying assumption that consumers always actually spend exactly what they plan to spend. Right? No fooling the household. We're also going to assume that government actually spends exactly what it plans to spend. Again, there's no fooling or no surprises in government. We'll make exactly the same assumption with respect to foreigners. Foreigners buy domestically made goods and services exactly as they plan to. The difference, however, is going to be on investment. Here, we're going to allow businesses to be surprised, in which case their actual plans, or their plans, may actually be different than what actually happens. So right now, companies are beginning to report their third quarter earnings. And one of the things that we'll hear over the next couple of weeks is things like such and such a company had revenues or profits or sales above expectations, right? Or below expectations, suggesting that there was a difference between what businesses were planning to do and what actually happened. So remember, the way that businesses make plans is they have to have a forecast of what they're selling to the other economic agents, consumers, governments, and foreigners, as well as other businesses. But not every forecast is accurate or true. So it's possible that I'm planning to build a lot of widgets and sell them, and lo and behold, for some reason, consumers aren't buying. Or maybe they're buying more than I wanted to produce. They surprised me on the upside. Now we get differences. And that suggests that businesses can be fooled some of the times, or at least that there are surprises between actual and plans. So that's where our planned expenditures will differ from our actual expenditures. So now we can write a planned expenditure equation where we use planned expenditures, superscript, right? So planned expenditures is simply consumer spending plus planned investment plus government purchases plus net exports. Now let's look at each of those 4 planned spending components in a little bit more detail. So starting with consumer expenditures, recall that consumer expenditures basically can be broken down into 3 categories: durable goods spending, non-durable goods spending, and services. Durable goods are spending on items that are expected to last 3 years or longer, things like automobiles, trucks, airplanes, boats, furniture, appliances. Non-durable goods spending is for items that generally will last less than 3 years, magazines, food, clothing, and such. And services are things that you consume immediately, right? Restaurant meals, electricity, doctor's appointments, transportation services, and so on. I point out these differences because when we think about durable goods spending, these are generally very expensive items, and they are often bought on credit. That is, the consumer is borrowing money in order to buy cars, trucks, airplanes, boats, furniture, appliances, so on and so forth. So that, at least that portion of consumer spending should be responsive to changes in the real interest rate, the cost of borrowing. And so we can think then about our consumption function, which, by the way, is exactly the same consumption function that we had before. Remember back when we talked about our desired saving function, we had a consumption function. So here, consumer spending is equal to autonomous consumption plus our friend the marginal propensity to consume times disposable income, income minus taxes, minus C, simply a parameter, times the real interest rate. So this parameter C simply tells us how sensitive is consumer spending to changes in the real interest rate. And notice, there's a minus sign. As the real interest rate goes up, the cost of borrowing rises, households will borrow less money, and therefore spending will also go down. Now, if we look at autonomous consumption, we would say we've got exactly the same subcomponents that we had earlier. Consumer confidence, household wealth, expected future income. Again, we talked about all of these when we were deriving our desired saving function. We argued then and we continue to argue that increases in any one of these, as consumers become more optimistic, as consumers become wealthier, as consumers' future income rises, expected future income rises, even though their current income has not changed, their consumption expenditures will rise. That's why all three of those have a little plus sign at the end of it. So we have a positive relationship in terms of movements in these variables with movements in consumption. Now remember, these are autonomous variables. So again, what we mean by autonomous, if we come back to our consumption function, these are variables that will impact consumer spending that are not explicitly in the equation, meaning that are not disposable income or the real interest rate. Now, because we write the consumption function this way, it also suggests that these three variables, consumer confidence, household wealth, and expected future income, have a much smaller impact on consumer spending than either disposable income or the real interest rate. If any one of these was a major factor in explaining consumer spending, we would want to put it into the consumption function equation. The fact that we just kind of put all those effects into autonomous consumption means, yes, there is an effect. It's important to recognize that each one of these three variables does have an effect on consumer spending, but it's not the primary effects. Now, our marginal propensity to consume, as we have also said earlier, is simply the change in consumption that's brought about by a change in disposable income. Okay? Change in consumption brought about by a change in disposable income. We will assume that the marginal propensity to consume is constant. And in fact, for the United States, it broadly is. We will also assume that in the aggregate, the marginal propensity to consume is less than 1, which again, the data suggests is clearly true. Now, that does not mean that each and every consumer has exactly the same marginal propensity to consume. We also know, for example, that low-income consumers have higher individual marginal propensities to consume than do high-income consumers. Right? Bill Gates' marginal propensity to consume is probably a lot lower than any of ours, right? Because the change in his income probably doesn't change his spending at all. But that's probably not the case for us. And some people, like my daughters, would argue that their marginal propensity to consume is actually greater than 1. But again, that's not possible, so unless you're going deeper and deeper into debt. And definitely not possible on the aggregate level. So you do want to ask your parents, if your parents ever ask, well, what did I learn in macroeconomics today? It's that your individual, you tell your parents that your individual marginal propensity to consume is greater than 1, and therefore they should send you more, not only more money, but a credit card with a larger balance on it. Just don't tell them that your professor said to do that. Okay, so, consumption function. Okay, investment. Let's think about the investment function. Now, investment typically has two parts to it. What we call fixed investment, which is our investment in plant, equipment, and housing. These are the things that businesses do to increase the capital stock, and that the economy does to increase the housing stock. Right? Fixed investment. There's also a component called inventory investment. Changes in inventories are going up and down. Right? Typically, when a company is producing more than it's selling, its inventories are rising. When it's selling more than it's producing, its inventories are falling. Right? So inventory investment generally reflects a mismatch between production and sales. Now, there are times in which companies want their inventories to grow. So if your sales have always been rising over time, there's a really good chance that you will also want to increase your inventories over time, so that your inventory to sales ratio may be constant, but rising sales would also suggest rising inventories. On the other hand, this is where the surprises can show up. It may very well be that you were planning on sales to rise, and therefore you produced more, but in fact, your sales disappointed. Now you've produced more, your sales have been weak, your inventories rise, but in this case, in an unplanned way. Right? This is that surprise that can come about that makes planned investment different from actual investment. Now, we have a new investment function. This is different both from what we did back at the saving and investment curve. This is also different from what is in the first edition of your textbook. So those of you who have a first edition, pay extra attention, because this is not in there, or at least it's not in there in this format. So we're going to say that investment, planned investment, is equal to autonomous investment minus D, simply a parameter, times the real interest rate plus this new variable, F bar, which we refer to as financial frictions. Financial frictions. What this new variable recognizes is that the relationship between short-term interest rates that the central bank can control and other interest rates that businesses borrow at is not always a constant relationship. Remember back in the beginning, one of the things that I said is most interest rates move up and down together. And that's still broadly true. But sometimes they don't. And this happens when the financial markets have a hiccup for some reason or other. That's a very technical economics term. Okay? And when the financial markets have this little spasm or hiccup, now all of a sudden that relationship can change. And that's what we want to try and capture here. Okay? Now, autonomous investment. Again, not a whole lot different than what we did before. These are the variables that are not the real interest rate or financial frictions. They would include business confidence. How optimistic are business